Time to welcome in our next guest. Jeffrey Small is with us, President, Arbor Financial. I look forward to talking about some of these big tech names that people might be able to nibble on once again. But first, let's just talk about the big picture. I mean, with today's move, we're saying a negative week, but you know what? If we can hold these gains until the end of the day, it's a winning week. Winning week for the S&P Dow and the NASDAQ if we can hold on to some of these gains just for the next few hours. What are you seeing here?
Well, I think so far, Nicole, every rally we've had so far has been a bear market rally. And no market's really ever bottomed before the recession happens. And with the street expecting that recession to happen mid-year 2023, which means this summer, everyone's just kind of buying the dips and selling the rips. And that's just the environment that we've been in since January of last year.
Right, so that's the whole thing, is that, they buy the dips, sell the rips, so bear market rallies. And when does that theme change? Are there too many headwinds for stocks to really take off?
Well, I haven't got the invitation in the mail yet that the Fed is lowering rates or they're topping rates off, but I think the mood of the markets will change dramatically. And I think what investors have to remember is that the greatest bull market in history from 82 to 2000, we had rates at the current level we're at today. So this interest rate environment that we're in really is going to be the new normal for the next couple of years. I see the Fed topping off rates here shortly within the next 30 to 90 days. And when that happens, we will see a rally in tech, because that same technology sector exploded when rates were still at 7.5%, 8%, even 9 or 10% during the 90s. And so that's a temporary reprieve for now, but it's a gift to the investors and it's a gift to the financial advisors that can reposition assets and dollar cost average very slowly into tech over the next 3 to 6 months.
Which tech, which names, and why?
Well, that's a great question. So obviously, I love the ones that have been beaten up the most, but they're the perennials in their space. I mean, they're the best of the best. And so I'm going to go offshore for the first one because it's been beaten up the most, but that's Alibaba. I think everyone's got to have a portion of that. Even Warren Buffett's got some Alibaba in their portfolio. You can buy it at an IPO price of 2014 today. And with the reopening, and hopefully the virus over there will sustain itself and eventually get herd immunity like we have here in the United States, and there won't be a mutation involved, that stock will definitely reap the rewards. I also like Meta as well. They're down 66% from their peak. We know all the reasons why they're beaten up. Will virtual reality become a reality? I'm not sure yet. Probably not, at least in the short term. However, all they've got to do is make a couple of nice moves on their balance sheet, reduce their expenses, and their profit goes way up. And so they're trading at a multiple of 11 times earnings. Who would have thought that's ever possible for such a cash flow rich business as Meta/Facebook? I also like Microsoft, which is down 31%, and of course Apple. And if you notice, I'm staying in best of breed, but these are gift-orientated prices for folks for us to start reinvesting before that rate hike or that rate stifling occurs. And the Fed says maybe 3 magic words: we're changing course. We're going to change course here. And so they may not raise rates anymore. They just stifle rates. These stocks will pop when that happens.
Yeah, so Baba, Meta, Microsoft, and Apple. And with Microsoft, I mean, that has been a clear winner. It really did well over the last year or so compared to some of the other names. Meta, people are wondering about the Metaverse and whether or not Zuckerberg's just put too much there and whether he'll change his tune a little bit. With Apple, the products and whether or not, one concern that I read today was the hardware replacement cycles that could be extended, and that may not be a good thing. And maybe regulatory scrutiny, that could be another thing. So there could be some headwinds for some of these names, right?
There's still headwinds for these names. There's still headwinds for the market. We're in a non-growing environment where earnings aren't going to grow. The number one driver for earnings is what? For the market to go up and for stocks to go up is earnings. And earnings, profit, net profits, the bottom line has got to increase if it doesn't go up. And so now we're going to be in that environment probably for the next 12 to 18 months. So this is not something that you buy and hold for a 12-month time frame. This is something you're going to have to hold for at least the next 3 to 4 years, because we see a sustained high rate environment at least until 2026, when the interest on the debt then becomes a much larger line item budget, and we see then the Fed being forced to lower rates regardless of what the environment is.
Yeah, and I know you don't like small caps, emerging markets, and consumer discretionary, and you know, you don't even have to explain why. I mean, I think the list is very helpful to know what you don't like. But I'm also wondering just about the big picture of the market. Do you see some new lows? Do you see a lot of choppiness and volatility?
There's no doubt we see a lot of choppiness. We see more volatility. The market is not bottomed yet. We have good days and bad days. The catalyst for the market to go south are further earnings revisions to the negative. The consensus I think we're going to see this year is revisions from -2 from last year for this year to -5 in terms of the lack of earnings growth, -5% reduction year over year. If that number gets larger, then of course the market will respond in kind, unfortunately, in that sense. And so we need earnings to turn around here, Nicole. That's the number one common denominator that will drive this market forward. But for now, we're stuck in a mode of non-growth until the Fed either pauses or decides to re-stimulate, but they won't do that until the economy actually physically starts to go through some difficult times. And we see unemployment factor maybe back up over 4.8 to 5.2. Once we see unemployment up that high, then we see the Fed re-stimulating.
Yeah, and you know, with the earnings, the expectations, as you said, to have these turn around and see better days, but really the earnings expectations are really being questioned, that they are still way too optimistic at this point. Jeffrey Small, nice to see you. Happy New Year, President of Arbor
Happy New Year,
Financial.
Nicole.
Thank you.
Thank you.